Alright, great. I'm going to be going over just an introduction towards ICT and what it is and how to interpret it in the market. So the market moves through liquidity and imbalances. Now, liquidity can be interpreted as buy stops, sell stops, the amount of money to move the market from one side to the other side, shorts, longs, however you want to think about it. Liquidity is being used every single second in the marketplace, and imbalances are being created through price runs. So a simple way to see it is a 3-candle pattern where you have one candle, another candle, and your last candle. So 1, 2, 3. This right here would be liquidity. And that's where people put their stop losses at. They put their entries wherever they get into the trade, and they put their stop loss at the high. And it's the same thing for, so these are going to be your liquidity. That's how you see your liquidity. People are going to put the stop loss at the top, and it's going to be the same thing for your shorts. Or I mean for your longs. My bad. 3-candle pattern, just the opposite direction. You're gonna put your stop loss here. The market's gonna go take you out or whatever it does. This is an area where liquidity is based on. So it's easy to see, and you don't need any third party or any data that you have to buy, like, I don't know, bookmap, order flow, something institutional telling you that that's where orders are. You can just see it based on the candlesticks, and that's all you need. Now, you understand simple liquidity. It's at the highs and the lows. You can understand your imbalances. So one imbalance would be something called the fair value gap. So your fair value gap, let me make these a little bit closer. Your fair value gap is going to be a 3-candle pattern with a gap in the middle. So you'll take it from the high of the lowest candle and the low of the highest candle. And if there's no wicks in between, that will be your fair value gap. And you're also going to have them on price runs that are going the opposite direction. So you'll have your fair value gap right there. That's going to be your fair value gap. Now these have names towards them. The fair value gap that is on the buy side, it's called BISI. It's going to be your buy side imbalance, sell side inefficiency. Then you're going to have your SIBI, which is going to be your sell side imbalance, buy side inefficiency. It's just an easier way to know what fair value gap you're looking into, if it's a bullish fair value gap or if it's a bearish fair value gap. That's very simple and easy to understand. We'll go into chart examples. Okay, now we have chart examples. We're gonna have the example of liquidity at the highs and the lows. You can see that the market goes for them both, so you understand that there's liquidity being taken out and being put into the market. And as you see, also you have your 3 candle pattern. 1, 2, 3. You're gonna have your Forel or your Bissy. And just like you have that one, you also have one to the left right here. This is called a Sippy. And as you see, you have that one. You have another one right here. Another one right here. Another Bissy. Boom, 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 boom. You have another one right here. So as you see, the market is creating a lot of these imbalances, and it's also creating a lot of these 3 candle patterns of liquidity. And as you see, the market is going towards the imbalance, going higher towards the liquidity. It's going towards its imbalance, going towards the liquidity, and it's just moving like that. So what I recommend as homework is going to be to just sit back and watch the market, get a flow, get a feel for it, understand how it moves. And as time goes on, you can annotate and put lipstick onto your chart and see how those areas react. Because as you see, these things are put on the 5-minute, on the 15-minute, on the hourly, daily. Well, you get the idea. Liquidity and imbalances are on all type of time frames. They have no limiter. You can see them on the 1 second. You can see them on the 9 month, 3 month, 1 month. So getting the grasp of liquidity and imbalances is very important for your foundation on ICT. Okay. So now that you have your idea of liquidity and imbalances, it's important to know which liquidity is important and which liquidity isn't, and what imbalances are important and what aren't. So the most important liquidity is going to be in the higher time frame charts. So it's going to be the 15-minute and the 1 hour. This is what institutions use for the intraday trading. As you see, you're going to have swings that are going to be taken out, and they're going to be meaningful for big runs. Same thing for the bottom. It's taken out, meaningful for the high run. And if you go into lower time frames, you might see that these are everywhere. A swing right here, taken out right here, swing right here, taken out right here, another swing, a swing right here, taken out. So lower time frame swings are, it's not that they're not important, but they're not as heavy in liquidity as they are in the higher time frame. There is more money being put on the higher time frame than there is in the lower time frame. There's a lot of people who scalp. There is algorithms, AI bots, robots that just scalp based off data, based off sell stops, buy stops. So it's important to keep that in mind, that the most important liquidity is going to be in the higher time frame, as well as your daily. So I'll give you something to look into your chart for. As you see in your daily chart, you'll look at the high and the low of each candle on that day, and you'll try and see how that day reacts. For example, we'll go out from the beginning of the range. The high of this candle, so the high of this day, because this candle is 1 day, is being taken out. Now, the second candle opens, comes higher, and closes below. Then the next one has a small gap, so you have your inefficiency or your imbalance, and it's opening, trading near the halfway point, and then closing below. It's closing below the low of this, right? So you can just get a feel of the market and see what it's doing and where it's reacting from. We have a massive drop, and we have a low. Then we have an open, a low near it, and then we spool higher. But there's no high being made on this one, and this is too far, right? So what the market is doing in this area is creating liquidity. What the next candle does is it opens, takes out this liquidity with a little bit more of a range, and closes back down. So after it closes, the next one opens, trades a little bit higher, goes lower, and closes. The next one opens, takes out the low, goes higher, takes out the high, and closes. It made it equal lows. So with the idea of liquidity is important for the marketplace, you understand that yes, one swing is important because you can take it out, but if you have two swings together, that would be equal lows or equal highs, which just tell you that there is more liquidity in that area. A lot of retail books tell you that areas that get hit like this once, twice, three times are areas of support or resistance or supply and demand, whatever it is. It's engineering or creating retail orders inside this for value gap. So now that you know that there's liquidity in here, you can possibly target this in the future if there's a reason to, if there's an idea to. So now that we did that, next candle opens, trades a little bit lower, comes to that high, then closes above and takes out this high. Then you have a gap in price. Then you have a close above right here. It finally takes this out and puts a wick above this candle. Next one opens, takes out this high, comes lower. Then next one opens, trades near the halfway of the body, closes inside this gap. Then you have an open, trades like the upper half of the gap, closes above this high. Next one opens higher, lower, closes in the middle. As you see, it just starts going sideways for a while, but once it starts going for a direction, this candle, it opens, goes this high, and then closes below, taking out this low. Then as the trading days continue, there's one candle on Wednesday, opens, takes out this high, leaves these two as equal highs, so engineered for when the market wants to go higher, and then drops back into the range. Next one opens, touches the opening price or near the opening price, and then takes out 1-2 days worth of liquidity. Next one opens, takes out another day and another, so it takes out another 3 days. Next one opens, doesn't really do much, it doesn't take out the high or the low, which is another thing you could look into. When there's days where a high and a low haven't been taken, like a day where it's basically consolidation because no big objective was taken, you can see and understand that there's going to be a large range, because the next day, the low of that day is taken out, and so is the high. Also the high that was not taken out. But this would still be important to see how it's being dealt with or if it's being left behind. So this would be something to keep an eye out. Once it does that, opens, comes lower, closes back above, opens, goes higher, closes below 1 and 2, it makes equal lows, which then the market opens and goes towards those lows. So all of this is done in higher time frame. which can give you an idea of bias using only liquidity and imbalances. Seeing how the market is reacting, where it's opening, where it's closing, where it's reaching for, where it failed to reach for, how it's going to react from taking out that area. And as you know, this is all fractal, so anything you see on the daily, you'll see in the hourly, you'll see in the 5-minute. So again, homework for this would just be to Monday, Tuesday, Wednesday, Thursday, Friday at 9:30 a.m. to just watch the market trade live, and then get a feel for it. Don't place any trades, no demos, no nothing, just a book and a pen, and see how the market is reacting off of areas. And don't even try and predict anything yet. There's no reason to try and predict anything. This is just to see how the market is reacting. And then once a week or two goes by, that's when I would recommend starting to predict or trying to annotate the chart. Predicting right now would be a little bit too much, but if you just annotate your chart, you can see that these areas being hit. So you can get a feel for what it is to read price. One last thing that's also important, in this little gray box, as you see, I have a black line in the middle, and what this is it's a for value gap range, right? So if your value gap is a PD array, a PD array is a premium discount array. What that means is that these 3 candle patterns will provide discount to the market. So me personally, I like getting in at the discount of the price range. So as you see, there's the up and the down, depending on what fair value you're looking for. If you're looking at a BISI, then the lower half is your discount. And if you're looking at a SIBI, the upper half is your discount. So as smart money concepts, we always want to be getting in at the 50% or lower for the best price run and for the best type of algorithmic move. So algorithmic price delivery is very, very simple. So algorithmic price delivery is very simple. It's the engine of price and the engine of delivery of price on a time basis continuum. So every price run is going to be starting from a consolidation. From consolidation, the only thing that can happen after that will be expansion. After expansion is where anything else can happen. So you can have all the other 4 type of stages of price. So consolidation is the beginning, expansion is the secondary part of the price delivery. Then you can have retracement, reversal, or consolidation again. If you have retracement, it's obviously like your stairways to heaven. If you get reversal, that's like your V type of movement. And again, you can get consolidation from your expansion. So all of those are very simple to see. And there's also simple models for them. So there's number 1, consolidation model. Okay, cool. So you have your consolidation right here. It's not the best consolidation, but it is consolidation. So consolidation model, you mark the lowest body, not the wick. You're not gonna like that to that. You're gonna go from the lowest body to the highest body, and you're going to mark out your range. This is your consolidation range. For this, you're going to look for the 50% above or below, depending on what your bias is. So if you want price to go lower, you're going to be looking at the discount above. If you want your price to go higher, your discount is going to be below. Then you're going to be trying to find your PD array. So right now you're going to be using your fair value gap. You're going to try and find it being used to go lower. So as you see, boom, 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 consolidation. You have your expansion. Then you have your retracement. Now it's important because this is two models in one, as you can see. Well, not yet. I'll show you why it is two models. You have your expansion, right? So consolidation, expansion, and yes, you have your retracement towards the 50%. So for a proper algorithmic price delivery run, you're going to want to see the 50% being hit on your expansion. If it's not being hit, then that means you're missing either something on the upper side of the premium half that is telling you that price is going to go lower faster, but don't focus on that yet right now. So as you see, high to low, that's your expansion, and then you have your retracement with the swing high. This swing high is a fake retracement. As you see, market takes it out into this fair value gap and then delivers lower. So this is two very important models of algorithmic price delivery. Again, from the low of the body to the high of the body of the consolidation range. Then you're going to have your fair value gap. In that fair value gap, you can either get in at the 50% of the fair value gap or the 50% of the range if the fair value gap is in it. So as you see, so this is going to be your consolidation model. As you see, it's being played out right here using this fair value gap. And you also have a 2-in-1, which is your expansion retracement model. Taking out this high into an important area of your fair value gap. Something I can get at the moment to use is the idea of looking at the market in a way of how can the market use multiple things at once to make a higher probability. For ICT, it's not guaranteed that you're going to have 100% win rate. There are models where you can have 80, 90, 95, and it can be lower take profits, 1-to-1, 2-to-1, 5-to-1, whatever it is. But the highest probability is when you mix in a lot of ICT ideas, and you also want to have the idea of time into your trades. But for this moment, you can see that you have liquidity and you have your inefficiency or your imbalance. It's playing off the idea of high to low in the range, going into discount of the range, taking out liquidity, so taking out stop losses, and going into a fair value gap, into imbalance, so it's rebalancing the market, and then it's ripping lower. Something important as well, again, is seeing how the bodies are telling you the story. So wicks are going to do the damage, bodies will tell you the story. As you see, no body closed into the discount range. That in itself is important because it will give you enough information and tell you that it's being sensitive and it's possibly going to be in a hurry. So this candle opens, trades higher, and closes back into the range, and then as you see, it's just speed, and from that speed it continues going lower and lower. And this being Wednesday at 8 p.m. that ended up being the high of the day of something so simple of liquidity and imbalances in your consolidation and expansion retracement model. Okay. So again, homework, make sure you do it. Any questions, let me know. So yeah, take care.